The Million Dollar Margin Club reviews Trading in the Zone by Mark Douglas, an examination of the psychological side of trading. In Chapter 1, The Road to Success, Fundamental, Technical or Mental Analysis, Douglas discusses three forms of analysis. Fundamental analysis, which many once thought to be the only true analysis of the market. Technical analysis that has grown in popularity within the growing community of day traders, and mental analysis that Douglas feels is the most important. Without mental analysis, we are unable to become the consistent traders we want to be. The best traders think differently than other traders. They have attained a mindset that allows them to remain disciplined, focused and confident despite adverse conditions. Mark Douglas expands further on the subject of the dangers of emotional trading in Chapter 2, The Lure and the Dangers of Trading. There is an attraction to trading, the ability to make money with no one to limit our freedom of creative expression. The market offers unlimited opportunities and ways to interact with it. These unlimited opportunities, combined with unlimited freedom, often lead to consistent failure. This creates a psychological challenge that most people are not even aware of and so don't know what to work on to solve the problem. We are not prepared to function in an environment like the market with no boundaries. Our upbringing in whatever society and family we come from will have instilled in us an expectation of limits and judgment. Such limits can become denied impulses, which can build up and become addictive and compulsive behavior patterns. These can affect our ability to stay focused and be consistent in our approach to trading. We have been given structure and rules to help us conduct ourselves properly in society. The market's only structure is that you can buy or sell when trading. Beyond that, the only structure for our trading can come from ourselves. The problem is, we are reluctant to take responsibility for our trading decisions, and the easiest way to avoid that responsibility is to take random, unstructured trades. Any trade can be a winner whether you are a great analyst or a lousy one. It takes effort to become a consistent winner, but it is easier to avoid the necessary mental work needed in favor of random trading. Another problem that can keep us from creating structure and becoming a consistent winner is addictive behavior. Addictive behavior is most often caused by a repetitive, euphoric feeling in our brain when getting a surprise we want. While getting a surprise when we expect something else can lead to emotional pain. The problem with addictive behavior is it leaves us blind to any possibilities that do not lead to what we desire or expect to give us good feelings. One more problem that our upbringing in a society has caused with the way we think is how we interact with others. We have learned at some level to control social situations through manipulation. The market, while composed of numerous people trading, is not a social environment. Traders cannot manipulate the market to do what they expect, even as they believe otherwise. Instead of trying to control the market, we must learn to control ourselves. In Chapter 3, Taking Responsibility, Shaping Your Mental Environment. Douglas discusses another tendency of traders to blame everything but themselves for losses. Doing so releases the trader from feeling responsible, but also takes away any control they have in their trading decisions. Taking responsibility for your trading decisions is one of the primary differences between success and failure. Often, you must create a new version of yourself to accomplish this task. As Douglas states, the tools you will need to create a new version of yourself are the willingness and desire to learn, fueled by your passion to be successful. This chapter discusses many ways to accomplish that goal. Control what you can by having a trading plan, practicing disciplined trading and managing risk. Every trade, winning or losing, is a learning opportunity. Douglas believes having a lack of fear translates into a carefree state of mind, similar to a state of mind many athletes describe as the zone. Most athletes, or for that matter traders, can never reach the zone due to their fear of never making a mistake. This chapter discusses many ways you can identify the fear inside you and ideas of how to overcome it. Douglas wants us to remember that trading is a matter of probabilities, not certainties. How you react to loss is extremely important. Although a good plan and positive thinking can be helpful, you will inevitably experience loss. A novice trader will often blame the markets. Only the very best traders have reached a point where they can accept complete responsibility for a particular trade. Taking responsibility and accepting at the deepest part of your identity that you, not the market, are completely responsible for your success or failure as a trader. In this chapter, he has emphasized the need to take responsibility, not blame, for your trading decisions. Avoid the traps of self-doubt and of euphoria, overconfidence, which can lead to missed trades or taking uncontrolled risks. Don't think of the market as something that owes us good trades or as something to blame for bad trades. The market is random probability that we continue to learn to prepare for by taking responsibility for our trading decisions. In Chapter 4, Consistency, a State of Mind. Douglas calls out the importance of consistency in trading, saying it is a state of mind rather than external factors that lead to this consistency. Trading is not easy. It is necessary to have your mind in the right place to work with the principles of trading. Focus on accepting risk without fear. Getting your mind right and not fearing what the market might do is a key part of turning the corner as a trader. Douglas uses stories to help present many of the ideas he is describing in a relatable way. Stories have been added to this chapter to help explain aligning your mental environment. One story helps explain that not everyone fears the same thing, though our own fears might make us believe otherwise. Another story equates learning the right mindset to finding an error in a computer program. It seems difficult until you have learned how to do it. Douglas calls this the aha experience. Getting your mindset to accept the consequences of your trades without fear or emotional discomfort, the feelings of being wrong, losing, missing out, or leaving money on the table, is the lesson presented by Douglas and is a good next step after recognizing the fears we have while trading. In Chapter 5, The Dynamics of Perception, Debugging Your Mental Software. Douglas reaffirms that the market is not to be feared. It simply provides information. It's your own thinking that determines how you perceive the information, how you feel, and whether you are in the right state of mind to trade whatever the market is offering. Trading like a professional means being able to see the market from an objective perspective, to trade without resistance or hesitation, but with caution enough to avoid overconfidence, creating the new mindset of a trader. From our external environment, our senses create memories, distinctions, and beliefs, creating energy structures within our minds. Douglas proposes with logic that if what we learn and remember is in the form of energy, then we have an unlimited capacity to learn. Learning and being aware are not just part of storage capacity. We do not take in information and just know everything. Our memories, distinctions, and beliefs affect what we sense, limiting how much of it we perceive and leaving many of the possibilities of that information left unseen. With an example, Douglas provides information on how our minds are designed to think and process information, how these processes affect what we experience and our ability to recognize new possibilities. We learn about risk being relative, but personal perception makes it seem absolute. The unconscious tendency to associate such as similar experiences as picked up by our senses and interpreted by our state of mind is also presented to show how the past can affect the now. In Chapter 6, The Market's Perspective, we learn that typical traders will perceive risk from the most recent few trades, while the best traders are not affected by fear or overconfidence due to their last or even their last few trades. These best traders may seem to have a natural edge over typical traders, but almost every trader has to train their mind to stay focused in the now moment opportunity flow. A possible secret to the nature of trading is to have at the core of our ability to trade without fear or overconfidence, perceive what the market is offering from its perspective, stay completely focused in the now moment opportunity flow, and spontaneously enter the zone, having a strong belief in an uncertain outcome with an edge in your favor. The best traders believe unconditionally that anything can happen. The most fundamental characteristic of the market is its unpredictability. Traders often overlook this fact, leading to repeated errors. All traders, despite individual motivations, are driven by the desire for profits. The market behavior reflects the traders' collective beliefs as they trade, feeling the prices are low, or the prices are high, or they are undecided. Every trader's belief becomes a market variable and influences price movement. Understanding and accepting the uncertainty this creates is crucial for success in trading. In Chapter 7, The Trader's Edge, Thinking in Probabilities, Douglas compares a casino's consistently profitable results from seemingly random events and the inconsistent results of most traders despite the belief that the market is not random. Understanding probabilities is key. Even events with probable outcomes can produce consistent results with favorable odds or edge and a sufficient sample size. Successful traders approach trading like a numbers game in the same way casinos and professional gamblers do. Analyzing market patterns provides traders with an edge, similar to casino rules favoring the house. Successful traders focus on maintaining favorable odds and accumulating a large sample size of trades to achieve consistent profits, acknowledging the randomness between wins and losses despite having an edge. Despite similarities in market patterns, having different traders influencing the market makes each moment unique. Traders need to accept the uncertainty of each trade. The need to be right can cause traders to ignore the probabilistic nature of trading, holding losing trades with conviction. Traders must embrace uncertainty and adopt a neutral, open mindset. Manage expectations to avoid emotional distress and improve decision-making. Our minds tend to avoid pain by ignoring information that contradicts our expectations. Have a probabilistic mindset for trading with these 5 fundamental truths. 1. Anything can happen. 2. You don't need to know what is going to happen next to make money. 3. There is a random distribution between wins and losses for any given set of variables that define an edge. 4. An edge is nothing more than an indication of higher probability of one thing happening over another. And 5. Every moment in the market is unique. In Chapter 8, Working with Your Beliefs, Douglas expands on the fundamental truths and discusses how to integrate them into your mental framework to become a successful trader. The truths are further described as 4 key skills. 1. A carefree state of mind, being confident but not euphoric, feeling no fear, hesitation or compulsion, adjusting your mindset to work with the 5 fundamental truths at a core level. 2. Objectivity, a state of mind where you have access to everything you have learned about the nature of market movement. 3. Making yourself available, coming to the market with no agenda other than to let it unfold any way it chooses. 4. Trading in the now moment, not associating past experiences with an opportunity to get into, out of, add to, or detract from a trade. By mastering these skills and holding to the fundamental truths, you can enter the zone and be receptive to market opportunities. A reminder that the market is neither positive or negative in its patterns is emphasized. It is only in ourselves, our beliefs, that negative and positive thoughts can cause us to enter any particular state of mind, lose our objectivity, make errors or lose opportunities. Our state of mind is always the absolute truth. If we feel confident, we are confident, and if we feel afraid, we are afraid. Moving toward the zone involves everything learned so far, accepting the psychological realities of the market so we can accept the risks of trading, eliminating the potential to define market information in painful ways, leaving us nothing to protect ourselves from. This gives us access to all we know about market movement, seeing all the possibilities we have learned objectively, having an open mind to see new possibilities, edges that we couldn't see before. Finally, reaching the best state of mind to enter the zone and tap into the now moment opportunity flow. In Chapter 9, The Nature of Beliefs, we are shown the importance of integrating the 5 fundamental truths with our belief system and how complex this process will be. The challenge of changing existing beliefs that may conflict with new ones. Learning to change these beliefs before beginning the exercise towards the end of the book is encouraged. Beliefs affect our lives in 4 ways. 1. Managing perception and interpretation of environmental information. 2. Creating expectations, projecting beliefs into future experiences. 3. Guiding behavior, ensuring actions are consistent with held beliefs. 4. Influencing emotional responses to outcomes. In a story about a social experiment involving free money, we are shown how powerful belief can be in shaping our perception, expectation, action, and emotional response. Tweaks to the story show the potential for different outcomes with different beliefs. In an exploration of the difference between beliefs and truth, we see the challenge of seeing the truth through the influence of our personal beliefs. Here are 4 statements to help define truth. 1. The environment manifests in countless ways, overwhelming any attempt to comprehend its entirety. 2. Beliefs represent a limited perspective of reality, not an exhaustive understanding. 3. Satisfaction hinges on beliefs aligning with outcomes. Consistent fulfillment of expectations implies truthfulness. 4. Dissatisfaction signals beliefs that fail to effectively navigate environmental conditions. Therefore, truth is what works or leads to satisfaction. In Chapter 10, The Impact of Beliefs on Trading, we are shown the strong motivation to be believed and to have others share our beliefs. While being believed creates good feelings, not being believed often leads to arguments or conflicts. Not being believed can feel like an attack and lead to wanting to attack back. This also explains why it is hard to be a good listener. From the moment we start listening, we begin to compose a response and may even be inclined to interrupt. 3 characteristics of beliefs. 1. Beliefs have a remarkable resistance to change, often enduring extreme pressure or force. 2. Beliefs fall into 2 categories, active and inactive, with active beliefs demanding expression. 3. Beliefs operate on a subconscious level, influencing behavior and perception even when not consciously remembered or accessed. The final consideration in this chapter is self-evaluation and how one's perception of self-worth can impact trading success. We all have positive and negative beliefs about ourselves that can influence trading decisions and outcomes. Douglas mentions barriers linked to these beliefs that can lead to consistent drawdowns. Douglas has termed this the negative zone, where money flows out as easily as it flows in when you're in the zone. In Chapter 11, Thinking Like a Trader, we delve into the 3 significant phases that mark a trader's growth: mechanical, subjective, and intuitive. The initial mechanical stage initiates us into the realm of self-trust, precision in executing trading systems, and the concept of probabilities. It's a training ground for fostering a culture of consistency. Progressing onto the subjective stage, our relationship with the market matures. We maneuver the market dynamics more freely. But this phase also demands vigilance against potential self-sabotage propelled by unresolved personal issues. The final intuitive stage is about trusting spontaneous intuition that arises from seasoned experience. Trading is metaphorically equated to gingerly walking across a narrow bridge over the Grand Canyon. Minor distractions can escalate into substantial losses, thus underlining the need for unwavering focus. An exercise has been given at the end of Chapter 11, Learning to Trade an Edge Like a Casino. There are a number of steps for setting up the exercise, including picking a market, choosing a set of market variables that define an edge, determining trade entries, determining stop-loss exits, choosing a time frame to trade when determining entries and exits of the trade, determine when to take profits, trade in sample sizes such as 20 trades, test your edge, accept the risk based on share size and your sample size. You're now ready to do the exercise. Be patient. Take your time completing the exercise and repeat as necessary. Like an athlete, practice helps improve performance. Trading in the zone is a classic. It has been a favorite of traders looking to advance for good reason. Mark Douglas addresses the concerns that most traders confront at a critical point in their careers with great detail, examples, and exercises to practice with. Trading in the zone leads traders on a journey through the pitfalls of the market and, more importantly, their own emotions, namely fear and greed. Douglas is a knowledgeable and compassionate guide to achieving success in day trading. Trading in the Zone is a must-read and earns a 5-star review. If you would like to read the entire book, you can find a link under the description tab below this video.